Stock market trading. Level 1. Setting up a trade. Setting up a trade. As a trader, you must understand that you are not limited to only stocks. Rather, you have a wide choice of financial instruments to pick from. These instruments include bonds, forex, commodities, options, exchange-traded funds, futures, and the current E-mini futures contracts, i.e. the E-mini S&P 500 futures contract. Any of these instruments you pick for trading must trade under good volatility and liquidity so that you would have profit opportunities. To start with, liquidity. This defines the ability to quickly and efficiently carry out orders of any size without causing any notable changes in price. To further expatiate, liquidity denotes the ease with which stocks, shares, or contracts can be sold and bought. Liquidity can be measured in terms of depth. How deep is the market? How many orders are resting beyond the best bid and best offer? Immediacy. How fast can a large market order be carried out? Resilience. How long does it take the market to bounce back after a large order is filled? Width. How tight is the bid or ask spread? Markets with good liquidity will likely incline to trade with tight bid or ask spreads, and with enough market depth to fill orders quickly. Liquidity is important to traders because it helps ensure that orders will be filled with minimal slippage, filled without substantially affecting price. Volatility. Volatility measures the speed and amount at which price moves up and down in a particular market. When a trading instrument experiences volatility, it offers opportunities for traders to profit from the change in price. Any change in price, be it rising or falling, generates an opportunity to profit. However, take note that it is not possible to make a profit if the price remains the same. It is essential for you to keep in mind that a trading plan developed and tested for an instrument, say E-minis, will not certainly perform well when applied to another instrument, say stocks. You may therefore need a separate trading plan for each instrument or type of instrument that you trade. One trading plan may perform well on a variety of E-minis. It is advisable and helpful for traders to focus initially on one trading instrument, then add other instruments as their trading skills and trading accounts increase. The primary chart interval you'll use to make trading decisions. Chart intervals are often associated with a particular trading style. They can be based on time, volume, or activity. The one you choose ultimately comes down to personal preference and what makes most sense to you. That said, it's common for longer-term traders to look at longer-term period charts. Conversely, short-term traders typically use intervals with smaller periods. For example, a swing trader may use a 60-minute chart, while a scalper may prefer a 144-tick chart. Keep in mind that price activity is the same no matter which chart you choose, and the various charting intervals simply provide different views of the markets. While you may choose to incorporate multiple charting intervals in your trading, your primary charting interval will be the one you use to define specific trade entry and exit rules. Indicators and settings you'll apply to the chart. Your trading plan must also define any indicators that will be applied to your charts. Technical indicators are mathematical calculations based on a trading instrument's past and current price and/or volume activity. It should be noted that indicators alone don't provide buy and sell signals. You must interpret the signals to find trade entry and exit points that confirm your trading style. Various types of indicators can be used, including those that interpret trend, momentum, volatility, and volume. In addition to specifying technical indicators, your trade plan should also define the settings that will be used. If you plan on using a moving average, for example, your trading plan should specify a 20-day simple moving average, or a 50-day exponential moving average. Rules for position sizing. Position sizing refers to the dollar value of your trade and can also be used to define the number of shares or contracts that you'll trade. It's very common, for example, for new traders to start with one E-mini contract. After time, and if the system proves successful, you might trade more than one contract at a time, thereby increasing your potential profits, but also maximizing potential losses. Some trading plans may call for additional contracts to be added only if a certain profit is achieved. Regardless of your position sizing strategy, the rules should be clearly stated in your trading plan. Entry rules. Many traders are either conservative or aggressive by nature, and this often becomes evident in their trade entry rules. Conservative traders may wait for too much confirmation before entering a trade, thereby missing out on valid trading opportunities. Overly aggressive traders, on the other hand, may be too quick to get in the market without much confirmation at all. Trade entry rules can be used by traders who are conservative, aggressive, or somewhere in between to provide a consistent and decisive means of getting into the market. Trade filters and triggers. Trade filters and triggers work together to create trade entry rules. Trade filters identify the setup conditions that must be met in order for a trade entry to occur. They can be thought of as the safety for the trade trigger. Once conditions for the trade filter have been met, the safety is off and the trigger becomes active. A trade trigger is the line in the sand that defines when a trade will be entered. Trade triggers can be based on a number of conditions, from indicator values to the crossing of a price threshold. Here's an example of a trade filter. Time is between 9:30 a.m. and 3 p.m. Eastern Standard Time. A price bar on a 5-minute chart has closed above the 20-day simple moving average. The 20-day simple moving average is above the 50-day simple moving average. Once these conditions have been met, we can look for the trade trigger. Enter a long position with a stop limit order set for 1 tick above the previous bar's high. Note how the trigger specifies the order type that will be used to execute the trade. Because the order type determines how the trade is executed, it is important to understand the proper use of each order's type. The order type should be part of your trading plan. Exit rules. It is said that you can enter a trade at any price level and make a profit by exiting at the right time. While this seems overly simplistic, it's pretty accurate. Trade exits are a critical aspect of a trading plan since they ultimately define the success of a trade. As such, your exit rules require the same amount of research and testing as your entry rules. Exit rules define a variety of trade outcomes and can include profit targets, stop loss levels, trailing stop levels, stop and reverse strategies, time exits. As with the trade entry rules, the type of exit orders that you use should be clearly stated in your trading plan. For example, profit target. Exit with a limit order set 20 ticks above the entry fill price. Stop loss. Exit with a stop order set 10 ticks below the entry fill price. Note, if you set this up as a bracket order, once one order gets filled, either other order will automatically be cancelled. If you place the orders manually, remember to cancel the remaining one to avoid an unwanted position. Getting ready for testing. When developing your trading plan, remember to include all of the important elements. Trading instruments, time frames, position sizing, entry conditions, exit rules. Note that writing down your trading plan is only the first step in a lengthy process. At this stage, it's just an idea or a template for the final product. You'll have to thoroughly test your plan before putting it in the market.